welcome. You're watching Market Drop, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICI Direct. Very good evening, Pankaj, and welcome to the show.
Hi, good evening, Geet.
Uh, Another volatile session for Indian equity markets with no clear trend visible. 17,800 on Nifty, well defended. IT, metals, auto outperformed while consumer durable, FMCG, infra ended in the red. Absence of FIIs is clearly seen putting pressure on the markets, Pankaj. What is your view?
I think, Geetu, rather than absence of FIs, actually last 1 week FIs have seen, or we have seen relentless selling from FIs to the tune of about 9,600 crores. I think in the month of January, they've sold about closer to 16,000 odd crores, largely because of this is a part of their annual exercise in terms of portfolio adjustment. Which
Okay.
happens usually at the beginning of the year. So we've seen a good amount of selling, and contrary to that, a lot of global markets have done quite well, be it US market, be it Europe market, because Europe market is looking particularly strong. Hang Seng, largely because of the Chinese reopening. So all of them have sort of gained 3 to 5%. So
Right.
overall, this particular week we have sort of underperformed largely because of FI selling. Our sense
Mhm.
is that we've seen Nifty rallying from say 16,700 kind of a level to about 18,800 kind of a level
Mhm.
in the past 6 weeks, and whatever correction we are seeing is just a 50% of that particular rally. So I
Mhm.
think overall, our sense is that if we are able to sort of resume this uptrend, what we have seen on Friday to say probably extend this rally beyond 18,150, then our sense is
Okay.
that Indian markets will also sort of participate, which is what we would expect. So our sense
Mhm.
is that overall the FI selling should subside next week. And
Mhm.
given the fact that domestic macros are still good, so our sense is that probably next week we should see some catch up by the Indian equities.
Mhm. Pankaj, we talk about India shining, we talk about India being resilient. But what is that FIIs are looking out for in India? Because India is well placed domestically. The numbers, economic situation is quite, well in comparison to the developed nations and also the emerging markets. And why is it that they are selling and not showing interest in the Indian equities?
So actually, that's not the case. So compared to global perspective, I think most of your FIs are quite overweight. The only
Mhm.
challenge is that when you sort of see it on a relative basis, we have seen US markets cracking in double digits, Europe or even Chinese markets have been down and haven't really sort of performed for a good period of time. So
Mhm.
the relative underperformance of these countries have been fairly large. So there is some bit of a catch up is what they are looking to do, and which is why some rebalancing is sort of happening. But
Mhm.
that apart, India is still sort of shining. Indian markets are still sort of resilient. So
Mhm.
I don't think any major macro negatives are creeping out. In fact, if you sort of look at largely the crude oil prices have been soft. We have
Right.
seen both domestic inflation plus the global or especially the US inflation coming down. I think which is a big positive for both Indian and global equities, especially
Mhm.
if you look at say US inflation. US inflation has been quite sharply lower at about 7.1 6.5%,
Mhm.
and this is still despite the fact that we are not seeing softening of the overall shelter prices, which constitutes about 32%. So, if which is what we would expect in the coming months. Similarly, domestically, if you look at inflation is 5.7%, this is still quite lower than what was the consensus expectation of 5.9 or RBI's expectation of say about 6.6% for this particular quarter. So that way, I think overall things are sort of shaping up well. It is just that the FIs have been sort of selling it aggressively, and which is why our markets have been sort of stuck in a range with a
Mhm.
downward bias. But I think
Mhm.
with FI selling largely should subside next week, so Indian markets hopefully should resume the uptrend from next week onwards.
Mhm. With the cooling inflation, do you expect RBI to pause for some time as far as the interest rates are concerned? Because the inflation latest inflation numbers, as you rightly said, they have come down below the RBI target of 6%. So can we expect RBI to pause, or do you expect RBI to still hike when it comes to really comparing with the developed nations?
So I think with the US inflation data, what is coming out is that there is 94-95% kind of a probability of 25 bips hike. Previously, it was divided between 25 and 50, but with softer inflation print, there is an expectation of 25 bips hike. Now,
Mhm.
domestically also, there is an expectation that probably one last hike of 25 bips is by RBI is sort of pending. But
Okay.
our sense is that when you sort of look at yields both globally and domestically, at least from an equity perspective, we are not
Mhm.
sensing that, but the bond markets are expecting a 25 bips kind of a hike. So
Okay.
remains to be seen because our sense is that with the kind of inflation way lower than even RBI's trajectory, uh,
Mhm.
so from that perspective, we would not expect a rate hike, at least domestically. But I think bond market participants are still expecting a one last hike of 25 bips.
Let's talk about the IT space. Everybody was saying that this quarter is not going to, the third quarter is not going to be good for the IT, but strong numbers from IT majors like TCS, Infosys, HCL Tech. So, what is your view now?
So yes, numbers from most of your IT majors have been quite strong given the global weak macro cues what we have seen. I mean, we were
Mhm.
expecting about 1% kind of a quarter-on-quarter constant currency growth. I mean, you look
Mhm.
at something like TCS, they delivered 2.2% kind of a quarter-on-quarter growth. Overall, when you sort of look at, there is a bit of a cooling of attrition. The deal wins have been sort of on the lines guided by the company. There has been a bit of a margin improvement, and margin improvement is further expected in coming quarters and next year. So that way we are sort of maintaining a buy on TCS with a target price of 3780. I think
Okay.
Infosys also, the numbers were quite good at about 2.4% kind of a constant currency growth, while the EBIT margins were sort of flat, but I think the icing in the cake was the deal wins. Deal wins were up about 22% quarter on quarter.
Mhm.
And this included only the large deals. And obviously, attrition is coming down as widely expected. And this company has also sort of revised the guidance. So from that perspective, nothing major negative is sort of coming out, and which is why we are maintaining a buy on this company also with a target price of 1730. Even HCL
Okay.
Tech also numbers were quite good at about 2% kind of a. So all three of them have delivered about 2% kind of a constant currency growth. General expectation or even our expectation was somewhere about 1 to 1.5. So numbers
Mhm.
are quite better. Even for HCL Tech, the TCVs are good at 4%. The company
Mhm.
is talking about overall a good opportunity, especially in the vendor consolidation space. So I think this, along with Infosys, are expected to be beneficiary of vendor consolidation. And
Mhm.
again, while this company is guiding for 13.5 to 14% kind of a growth, so
Mhm.
nothing major negative is coming out. I think the only challenge probably is on the outlook side, especially in some of the verticals and geographies. So, for example, geography-wise, Europe is considered to be slow moving in terms of decision making. So that is sort of impacting. The overall growth has been softer there. And some of the verticals like BFSI are also sort of experiencing some softness. But in
Okay.
general, overall, given the macro backdrop or given the kind of fear which was there, I think the numbers are quite better for all the top tier three, tier one companies. So that
Mhm.
way, I think IT companies have results have come as a positive surprise for the markets, including us.
So can we expect much better numbers from the second rung IT majors?
So again, it will be a company specific because, for example, something like LTI Mindtree, we expect margin contraction to be about 200 bips because they are undergoing a margin merger process. So 100 bips kind of an impact is largely because of this thing. We are still not
Okay.
sure, depending on which company, say, for example, if BFSI is a vertical, which is a main vertical, and if Europe,
Mhm.
for example, is experiencing softness, so you will continue to see volatility. Plus, I think vendor consolidation also might be slightly negative for smaller players. So, which is
Okay.
what remains to be seen
Mhm.
from the rest of the companies in terms of commentary. But I think the only overall sectoral challenge has been geographies like Europe, where the decision making is slow. Hopefully,
Right.
the kind of market behavior what you're seeing in Europe. So, for example, I think markets in Europe are looking a lot more better technically. So, something like
Mhm.
FTSE is already at a lifetime high. So, hopefully,
True.
we would not see that kind of economic damage given the higher inflation what we've seen historically. So, let's keep our finger crossed there.
Right. Another big news for the market, PVR Inox has finally received the merger approval from NCLT, and this indeed is a big trigger for the stock. Merger ratio of 3 shares of PVR for every 10 shares of Inox. What is your view on this merged entity, and how do you think see the things panning out for PVR Inox from here on?
So, well, the combined entity will have about 1,600 screens, which is 50% of the market share of the entire multiplex screens. And
Mhm.
they're aggressive as a combined entity of adding about 200 plus screens every year. I think the good part will be that they'll be able to bargain better for advertisement and also for distribution rights. And which
Mhm.
is where we are very hopeful that all of that benefit is going to sort of flow to the bottom line. I mean, when you look at
Mhm.
even the ad revenues are still at about 60-64% of the pre-COVID levels. So
Mhm.
obviously, merger will have these kind of benefit. Now, last quarter was particularly bad for both these multiplexes, but this time
Okay.
around, we have seen decent performance by some of the movies like Avatar 2, then Drishyam 2, and Kantara. So as a
Right.
result of that, we will see about 35 to 40% quarter-on-quarter growth in box office revenues.
Okay.
And the ticket prices are up also about 7, 8 odd percent. So that should sort of lead to better margins for both the companies in the range of
Mhm.
13, 14 odd percent. Last quarter, they were making losses. So number wise, we are expecting a sequential improvement in both the numbers. Uh, we continue to sort of maintain buy on both the companies. So in both the stocks, you will have upsides in excess of 20%.
Mhm. Talking about the banking space, this week was not that good for the banks. We saw some bit of profit booking, selective buying in banking space, and we have Q3 numbers now starting to come out, beginning with HDFC Bank. So, Pankaj, will earnings growth peak out for banks in quarter third?
So I think our sense is that while we've seen profit booking in some of the bigger banks, largely because of the previous rally, what we have seen, and but overall, from a number perspective, we don't expect any major disappointment to sort of happen. So while
Okay.
you'll have a good set of numbers coming out from this Saturday onwards, but our overall sense is that banking industry credit growth has been good at 18 odd percent.
Mhm.
NI growth is expected to be about 19 odd percent, and you'll see profit growth at much more higher at about 34 odd percent, largely
Mhm.
because the provisions are low. Now,
Okay.
coming specific to banks, I think HDFC Bank overall advances growth has been 20%. We would expect profit growth of about 16 odd percent.
Mhm.
I think
Mhm.
margins are going to remain steady. IDFC First Bank should do a lot more better because their credit growth has been 25%, 5%
Mhm.
quarter on quarter. And then they will see further more or better improvement in margins to about 6 odd percent. The profit
Okay.
is expected to sort of double. Federal Bank, again, 19% kind of a growth, so pretty good set of numbers, and profit growth should be 47%. So, as of now, there is nothing looking like major or any kind of a negative which is there in research in most of the bank's results.
Mhm. Pharma cramps space is witnessing some bit of pressure because of the COVID-led growth hangover now. Will you still like this place? Because I have, whenever we talk about the pharma, you like the cramp space more.
Yes, we have liked this space for quite a long time, but sadly, we haven't sort of gone right here. We've seen stock prices correcting 10 to 30 odd percent in the last 3 months, and largely because of the significant sort of a shrinkage in the COVID-led execution. Now, when we sort of look at FY21 and FY22 were very fabulous year because the companies did very little of, or they moved from R&D related capex to COVID outsourced manufacturing plus processes or formulations related to that. And that sort of helped companies like Divi's and Laurus to sort of do exceptionally well. Now they're again sort of shifting back to pre-COVID R&D and developing or devising new molecules. And for that to happen, it is going to take some time of say 2-3 quarters or 3-4 quarters maybe. However, what the companies are saying is that they are getting good inquiries, but to translate that into revenues will take some time, and which is why probably for the next 2-3 quarters, we would not expect much of a price performance, and also even from a number perspective, we are expecting Divi's revenues to sort of degrow by 24%, largely
Okay.
because the custom synthesis business or the CRAMS business will go down by about 47 odd percent. I think Laurus numbers would look slightly better. So their revenues are expected to grow at 14 odd percent. But overall, you will not see that kind of a growth in the EBITDA, and also we would expect margins to sort of decline by 270 odd bips. So there will be hardly any profit growth. So numbers are expected soft from this particular space, and which is why the kind of price beating they have taken. Probably it will take some time for these stocks to sort of perform. But let's see what sort of pans out in this quarter. But as of now, things are not looking that great, at least in the near term.
In the consumer discretionary space, what do you like the most as far as the earnings are concerned?
So again, what we are going to see is again muted set of numbers overall. I mean, when you look at say a company like Asian Paints, we would expect a lower volume growth of about 3% YY, largely because the last year the base was very high. Since there has not been a very great rural demand also, so overall growth is expected to be 5%. Now, prices of some of the raw materials have declined by 20%. So you'll see a gross margin sort of improvement overall on a quarter-on-quarter basis, though on a YY basis it is going to remain flat. So that
Okay.
would lead to a flattish kind of a bottom line for Asian Paints. Even for a company like Havells, we would expect them to sort of deliver slightly better set of numbers of about 9% kind of a top line growth, largely because cable business is expected to do well, and then you will have Lloyd business also sort of doing well. You will see margin sort of expanding a bit, but on a YY basis, you will still see margins or profit declining by 9 odd percent to 279 odd crores. So numbers
Okay.
are expected to soft. I think probably Q4 onwards, the numbers for both these companies or for this segment should start looking a lot more better.
A good comeback for metal sector. We saw a very smart recovery in most of the metal stocks. So you talk about Tata Steel, talk about JSPL, Jindal Steel, JSW Steel. So what's happening in the metal space? Sustainable or not sustainable?
So I think we all know that China has been sort of easing COVID-related restrictions, and that opening has sort of led to a new enthusiasm in the entire metal as a space. Now we have seen Chinese metal prices or steel prices rallying by 20%, and even
Okay.
for deliveries from February onwards, we are seeing higher prices by some of the players there. Now, some of that benefit we are seeing domestically also because Indian steel prices or HRC prices are also at a 3-month high. Players have taken a hike of 1,500 to 2,000 rupees per ton. And so that way, I think we are seeing a broad-based improvement in the entire metal as a pack. Now in this current quarter, we'll see some benefit of lower raw material prices. So we are expecting, say, for steel companies, overall improvement in EBITDA per ton could be in the range of 2,000 to 2,500 rupees per ton, largely because the coking coal prices have come down. Now the benefit of higher prices will be visible in Q4. So Q4 usually is a very strong quarter for metals. So
Okay.
I think for next few months, if nothing negative happens in China, then metal is poised for a good run going forward. And I think this quarter will witness some improvement, but I think Q4 will see a lot more better volume growth and a lot more better margins, even from current levels. So metal as a pack is offering some juice. So we like companies like Hindalco, Tata Steel. So I think these would be the top picks.
Mhm. Now is the time for hidden gems. So, which is the stock that we are going to talk about today?
So banking has been flavor for quite some time, and we are seeing or we expect a good set of numbers from most of the banks starting this weekend. So from
Okay.
that perspective, the stock which I am sort of highlighting or putting forward is IndusInd Bank. Here our target
Mm-hmm.
price is 1450. Now, overall, our sense is that this bank will witness an NI growth of 15%. The profit growth could be about 34 odd percent. ROE
Okay.
is expected to improve from say 10% to 14.5%.
Mm-hmm.
It's trading at a price to adjusted book of about 1.5 times. And even from a quarterly perspective, we are expecting good set of numbers. So we're expecting advances to grow at 19 odd percent. We should see an NIM's improvement largely because of decline in credit cost and steady asset quality. And profit should sort of grow at about 65% on a YOY basis to about
Okay.
1,915 crores.
Mm-hmm.
And I think overall, our sense is that this bank still can do a bit of a catch up compared to the historical valuation, average valuation which it used to command. And which is why
Okay.
we're liking this space entirely and in IndusInd Bank in particular.
So, hidden gem for this week is IndusInd Bank for target of 1450, 17% upside possible. So, now next week, which are the major earnings that will be on your radar and the Nifty levels that you are expecting the markets to trade in?
So we expect Nifty to sort of witness some recovery while banking stocks are expected to be in focus largely because of the earnings we are going to see. So right from HDFC Bank to IndusInd Bank to Federal Bank to IDFC First Bank, all of them are expected to sort of come up with set of numbers. So this is a first flavor of banking numbers we are going to see.
Mhm.
And which is why our sense is that if banks deliver overall, our sense is that if Nifty does not breach say 17,800 levels and is able to cross 18,100 kind of a level next week, then our sense is that the will see a fresh uptrend in Nifty. Otherwise, we could sort of get stuck in a range.
Mhm.
But since banking numbers are expected to come out, so we'll see banking stocks more in line probably compared to Nifty.
Thank you, Pankaj, for being with us. Appreciate your time.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.